Tom Bronson, and welcome to the Maximize Business Value webinar series, a series of educational webinars for business owners who are passionate about building long-term sustainable value in their businesses. Credits, captives, and cash flow. Oh my. This topic hits lots of check boxes on your way to maximizing business value and transitioning your business on your terms. This is volume 7 in this series. So far, we've attacked things that you can do in finance, operations, and human resources, marketing and sales, and building the ultimate transition team. If you missed any of those webinars, then you can check out replays of all of our webinars on our YouTube channel, Maximize Business Value. If you happen to go there to check that out, not only our webinars are there, the various speaking engagements that I've done are there, our podcasts are there, and a new thing that we started about a month and a half ago, Pod Snack, little bite-sized, yummy taste of our podcast. And so I would invite you to go there. And if you do go to our YouTube channel, please click subscribe, and then you'll be notified anytime that we post a new video. As I said, I'm Tom Bronson, president of Mastery Partners, and I'm thrilled to be joined by two great business advisors today, Gerald McAdoo and Ken Huffman. These two folks are superheroes when it comes to maximizing your asset, which is speaking my love language. So, Gerald, why don't we start with you? Tell our audience about yourself.
Sure. Gerald McAdoo, originally from the Michigan area, relocated here to Texas. Love working with business owners. With business owners and executives that we're engaged, they want and should focus on their core business, when and how they make money, their products, their services, cost structures, profitability, the core of their business. You talk about this all the time, Tom. We don't want to take time away from that. In fact, they likely need to focus on that. We guide them to discover, or rather uncover, the cash flow already existing in their business. And we operate kind of like a generalist and a specialist, I like to say. We are flying at 30,000 feet, sharing the perspective from a higher vantage point to identify areas worth exploring, immediate, one-time, even recurring cash flow, and then dropping down to 500 feet to execute on those areas of savings for them without disrupting their business or their vendor relationships. And we do that on our own dime.
Now, you know how much I love it when you bring up the fact that you are from Michigan. And where is it you went to school again?
The University of Michigan, Tom.
Oh, that's right. The University of Michigan. Didn't they lose a football game to Appalachian State University? Wasn't that like the biggest defeat in, college football history? Just so happens that, I went to Appalachian State University. I'm just bringing that up as a point of interest. And also, Gerald, I can't thank you enough. Gerald is off on vacation in California, and we had scheduled this, and then his wife says, we're going on vacation. And so he is visiting us from his condo in California. Ken, why don't you tell our guests about yourself?
Hey, everybody. I'm Ken Huffman. I'm a CPA and founder of Captive Nation. Graduated from Texas A&M. All right. Did accounting. Started with a big 4 accounting firm, KPMG, and then went to work for a small CPA firm. And there I started noticing there were a lot of business and tax strategies that CPAs did not know about. And so I went and gathered all the licenses, everything I need to offer that to CPAs. And what kept coming up over and over and over is the captive insurance. Everybody was very interested in that. And so now that's all we do is focus in on captive insurance. And I'll tell you more about it, but it's a private insurance company owned by a business owner. It's a great way to protect your business, decrease taxes, and build wealth. So it's a fun thing. It's a great thing that adds value to your business. Not right for everybody, but we'll see if it's right for either you or some of your clients here in a few.
Well, and so just to prove that I'm an equal opportunity offender, going to A&M, great university, but yes. What in the hell is wrong with that fight song? You're singing about it. Texans to beat Texas and a team that you don't even play anymore. That just doesn't make any sense. I'm sorry. Oh, I'm sorry.
Listen, Tom, It's important that you continue to maintain dominance,
Yeah.
okay,
Oh, got it.
over your rivals, regardless of whether you play them or not anymore.
Right.
All right. You got to
Right.
maintain the dominance. And so,
All right. Well, we better move on to before we start losing our audience on our college football stuff. So before we jump into our topic today, let me refresh you on why we do this webinar series. 72% of business owners have no exit strategy at all. And 48% of business owners who want to sell their business right now have no exit strategy. So that's part of the reason that the 83% of attempted transactions never reach the finish line. That just pisses me off. Our team at Mastery Partners have a combined 500 successful business transitions under our belt, and we're here to help every business owner on the planet get into what I call the elusive 17% club. That's the ones that can do that. That's the group of business owners who can actually transition their business on their terms. We want you to be in the 17% club. Let me ask you, do you know what your business is worth? And if you do, when you think about the value of your business, is this how it makes you feel? Or does it make you feel more like this? I'm guessing for most of you, it might make you feel like the latter rather than the former. So today we're going to talk about a lot of things that you can do to improve the value of your business. My charge to you is take tons of notes, and at the end, pick the 3 things that you are going to start doing today in your business to improve your business value. Kim has already, I noticed she's already dropped notes in the chat box. You can download those and take notes there. You can use, like I always do, you can use the old yellow legal pad and take notes, because I will always be taking notes during these webinars as well, because I learn great information that I can put to use. Like always, it's going to feel a little bit like we're drinking from a fire hose because there's lots to cover. However, take those notes because we want you to remember those things that are burning issues for you. And at the end, I'll ask you to write down the 3 takeaways that you plan to take action on immediately. If you're like me, you're going to a lot of webinars today and you're learning a lot of stuff. Walk away from here with at least one thing that you can put to use in your business. So in this series, we talk about lots of things, but today, the areas that we're focused are really around finance and operations of the business. So owners and operators think differently. Owners think about their business as an asset. Building long-term value in your business asset is the most important outcome to be in the 17% club. Which are you? Are you an owner or are you an operator? If you're an operator, you're stirring the sauce and you bought yourself a job. But if you're an owner, then you think about the value of your asset. We want you to get into that 17% club. So today we're going to cover 2 main topics to maximize your asset by improving your cash flow and building value with tax incentives and captive insurance. So let's start with tax incentives. Gerald, what are tax incentives and how do they work?
Oh, good question. Before I answer
nothing but good questions, Gerald.
Well, I was going to say I was having a stress-free vacation until you told everyone that I'm actually have a potentially unprotected home.
Oh.
So I'm going to wake the kids up. Tom messed it up for everybody. We're going back home.
Uh-oh.
But no, that's okay.
I'm staying at your house. What are you talking about? This is your house.
Well, we have a house sitter. We have a house sitter, and wink, wink. They are armed and dangerous. So, but tax incentives is money. It's money that most small and medium businesses are leaving on the table. And given a recent bill signed just a few weeks ago, 99.7% of businesses qualify, and they will forfeit this money if they delay. And Tom, I just don't believe in leaving money on the table. And it's important to know that these incentives can be stacked. You can qualify for more than one. You know, you don't build a house with just a hammer. And I know as soon as I say that, I'm sure there's a YouTube video somewhere of someone doing it, you know, but how many of us can do that? And would you really want to live in that house? So there are a range of specialized tax incentives available if you know where to look, and they can improve your cash flow. There are hiring tax incentive credits, which is a great program for almost every employee. It's called the Work Opportunity Tax Credit. I call it WOTC. Experience shows that most don't really know what it is, nor how to leverage it. The two most notable programs in addition to WOTC, Section 41 of the R&D tax credit, the startup tax credits, those are for companies with existing employees who are engaged in anything technically related. But clients will benefit from looking at all employer-based tax incentives. And don't stop there. There are special tax incentives available to commercial property owners. If you believe the IRS, and our experience does bear this out, a smidge over 92% of owners of commercial real estate across the country have not taken full advantage of property incentives such as accelerated appreciation. And this is a strategy that the IRS recommends. So virtually any business can benefit from employee-based incentives because candidates that don't qualify for hiring tax incentives can qualify for some of the others.
Awesome. So these are kind of four big categories, but it's not just four different tax incentives, right? There's a bunch of different things that you guys can investigate, right?
Oh, there are dozens of them. Absolutely.
Yeah.
And I could talk a little bit more detail about each one of those, but there were some significant changes in the current program.
You want to talk about the Consolidated Appropriations Act? Because is that where you're headed now? Because I can flip over to that slide, right?
Sure.
Yeah. So we actually had a conversation even as late as yesterday. Gerald's going to be the guest on our podcast on Monday, and he told me about the Consolidated Appropriations Act, or CAA. So I was blown away by the potential impact for business owners and their cash flow. So tell us about the CAA and perhaps the changes that we see in some of these tax incentives that have come up as a result of it.
Well, with this act that was signed at the end of December, so just a few weeks ago, there were several things that was in this act. It was 5,500 pages.
Wait, 5,500 pages. How long did it take for this act to pass Congress, both houses?
Well, interesting enough, there's a lot of back and forth beforehand, but they actually passed on the same day, both houses, which is
I'm sure they read all of it. I'm sure they read all
that's by a show of hands. Anybody? How many of you think that there's even one senator or congressman that actually read all 5,500 pages before they signed this into law? Great. Okay, go ahead, Gerald.
So there were several things that was in this particular act. Of course, there was the second round of PPP. There was some farm credit. There was some new funding for some areas that got left out before, cultural events and live entertainment. There was a surprise medical billing, employee retention credit that actually received its own section, EIDL. But there were three areas in particular that stood out for us that were important for our clients and potential clients. One was related to tax extenders. So I mentioned the hiring tax incentive, the WOTC portal. I don't know how many have heard of that. It's a federal government incentivizing businesses to hire what they refer to as these disadvantaged categories. They've been doing this for decades. Some of these categories, and actually the first was veterans. So started back after the end of World War II. And it incentivized employers to hire veterans. Anyway, they quickly added those who had served time. And for years, it stood as the Veterans and Ex-Felons tax credit. And over the past decade, especially the last 5 years, they added lots of categories to this, things like people coming off of long-term unemployment, which is a pretty large percent of our population now. Maybe where they live, they call them empowerment zones. It could be anyone or anyone who lives with them that is on some type of government assistance, like SNAP. There are some youth programs that are in this. So just depending on the types of positions that you have and those that you will have, you may have some turnover, and there may be some people that are coming through this system that might provide a tax credit. These tax credits on the hiring side range from $900 to $9,600. These are dollar for dollar offsets against federal tax income. That program is something that is usually retroactive, meaning, throughout the year, we never know if it's going to be in place, but they always extend it. In December, usually is, hey, congratulations, you're going to have this hiring tax incentive credit. They did something this time that they've only done once in 35 years, is they made it permanent, not just for 1, 2, or 3 years, but for the next 5 years. That's tremendous free money that's on the table. There's a disaster retention credit. It's something that's been around for a while, that you can get up to $2,400 per employee for 2018 and 19 if you're operating in one of these disaster areas. There are actually 282 counties that are eligible for that currently. There's the employee retention credit. That was a new credit created through the CARES Act. If you're familiar, I know most of our listeners here are familiar with the PPP program, the Paycheck Protection Program. That was a loan incentivized program to keep people on payroll. There's another program called ERC, the Employee Retention Credit. That is a tax credit to incentivize businesses to keep people on payroll. Most businesses that we spoke with were unfamiliar with it. They'd never heard of it, didn't get a lot of media attention. And if you took PPP, you couldn't get the ERC anyway. It was either one or the other. Now with the new legislation that's come about just a few weeks back, now they're allowing business owners who accepted PPP to go back into 2020 and calculate and accept the ERC. That's up to $5,000 per employee. Something new in this legislation. They actually extended this now to the first 2 quarters of 2021, and you can gather up to $14,000 per individual. So there are tremendous opportunities out there, Tom.
Holy cow, that is just a lot of stuff. And I mean, it's a lot of things for a business owner to wrap his head around. As you know, I'm pretty informed about a lot of this stuff, but I mean, you're telling me things today that I hadn't heard, and holy cow, there's a lot of incentives out there. So as a business owner, I know that it takes a lot of capital to grow a business, and I urge all of our folks on here to take advantage now. Do not wait, because these incentives may not be available for long. We've got some that are made permanent, but others that may not be available for long. And so I would take advantage of them as quickly as I can. So, Gerald, let's walk the audience through a couple of examples. Here's a restaurant in Houston, Texas. They hire about 10 people a year. They have 25 employees, own their own commercial property that they purchased for $1 million. This restaurant had to shut down operations during COVID, and they had at least a 20% income reduction in at least 1 quarter of 2020 as compared to 2019. So walk us through the incentives that you found for this restaurant.
Sure. Well, several. One, first, our WOTC program for hiring. Again, that federal tax credit up to $9,600 per employee that qualifies for that, a dollar for dollar offset against federal tax income. That came to about $12,000 by initial calculations. The employee retention credit, that's the ERC credit. It's a payroll tax credit that can be used immediately against current payroll, the company's portion of current payroll. That's another $350,000 of immediate use. Houston, Texas, there are several counties that are considered disaster areas in Houston. And if they qualified for those, that's an additional $2,400 in a federal tax credit per employee. And in this case, the example you gave, they do own commercial property. Over 90% of them have not taken advantage of accelerated depreciation. When you add up all these figures, we're talking just under $500,000. So, that 10,000 here, 100,000 there, after a while, we're talking about real money.
Yeah, no kidding. So what I'm seeing here, Gerald, is that these things stack. It's not like one or the other or something else. I mean, they're taking advantage in several different areas, right?
Oh, absolutely. There are significant opportunities. And often what we see is people tend to self-censor and miss significance opportunities. What we say is let's just have a conversation about them. You mentioned this before. This is kind of 15 minutes to 6 figures, you know.
Yeah.
Oh yeah. Yeah. Hey, it's better than Geico. 15 minutes can save you $300 or $400, whatever. 15 minutes can save you 6 figures. Come on. That's got to be your new tagline.
Yeah. And you don't know what you don't know. Right. So
Right.
you can at least contact Gerald and say, hey, here's the situation. I don't know if we can help them or not, but you might as well at least figure out what's out there and available to them. Then they can make the decision to go with whatever they want to do.
Exactly. Well, let's go another example. This is a manufacturing company also in Houston. We're not trying to pick on Houston here. They have about 25 employees. They typically hire about 10 people a year. They purchased their commercial property for $2.5 million. They also had to shut down briefly during COVID and experienced an income reduction in one quarter of 2020 as compared to 2019. So, Gerald, walk me through the incentives that you were able to find for this manufacturing company.
Sure. Some similar areas. Again, they're doing some hiring. Each industry is a little bit different, but across all industries, we see about 15%, 20% of candidates qualify for hiring tax credits. There's the R&D tax credit. That's the one for firms that are more technically competent. And I would tell you that most, if not all, manufacturing companies should be taking advantage of their R&D tax credit, and it's very often missed. The COVID retention credit, we're still looking at another $350,000 for them of immediate use. The disaster retention credit, another $60,000 in a federal tax credit for 2018 and 19. And again, it will begin to continue into 2020 as well. And they own property, a little bit larger property, so a little bit larger incentive of $185,000 and totaling almost $250,000 there.
No, that's $672,000 total. 672, almost 2/3 of $1 million. So between the two of these examples, we're talking over $1 million. And by the way, quick question for you: are these just extreme examples? Are these things that you're finding fairly commonly?
This is fairly common, Tom.
Yeah.
And with this new act, again, 99% of the companies actually qualify for these things now.
And many business owners don't even know that these exist.
They don't know they exist, or they don't know how to capture them. And if you believe there's a national publication, Forbes magazine, again, this was signed on the 21st of December. They wrote an article. It is how complicated this is. They actually wrote a 2-part article. They released the first part on Christmas Day, December 25th last year.
There's some light reading for you on Christmas morning.
and here's what they said. It said, for those who are looking at even the second round of PPP, it says, this means the second round of PPP funding in 2021, employers can coordinate and claim both PPP and ERC for 2021 as well as 2020.
No kidding. That is, wow. That is awesome. All right. So look, how what you're telling me is that there's lots of free money out there waiting for my business. Where do I sign up, and how do I know if I qualify?
Make it easy.
You want me to just give you my bank account number?
We'll take that. Social Security as well. In our 16 years or so that our research team has been doing this, we've developed our own proprietary software to help to identify these different opportunities that are available to business owners. And the best part about it, finding out whether these programs are available is at no cost to the business owner. So the best, most efficient way is really just to get time with me. In 15 minutes, it's often that we find, 6 figures returns. But I understand it. People are busy. I understand you don't have 15 minutes, so don't have the time to chat. Shoot me an email and we'll give you access to a confidential tool that would actually help get you on the right path. Awesome. But I think you mentioned the key point before. Tax season is rapidly approaching. You really need to take advantage of this now. You want to know what you're paying out or not paying out today. You wait till the last minute, and you may not have time to procure some of these programs before they sunset.
Right. We are like 5 weeks away from tax day, unless of course you live in North Texas, and then tax day doesn't come until later in the year. So No, you are absolutely right. All right. Well, we've talked a lot about tax credits. Let's make a shift over to captive insurance for a few minutes. So, Ken, in a nutshell, what is captive insurance and how does it work? Oh, you're on mute, Ken.
Couldn't do that. That may make it a little bit more interesting unless
Yeah.
people want to read lips. So
Hey,
let's not do that.
That's the first time I ever wanted to listen to you.
Absolutely. So captive insurance, it's a private insurance company owned by the business owner. Okay. The primary purpose is to insure the business that makes them all their money, right? And overall, it's a business strategy. It accomplishes three things really: to protect your business, decrease taxes, and build wealth. That's what a captive insurance company does. Who's it for? Any business. It doesn't matter because every business has risk, right? Now, where does it make financial sense? Any company that has gross sales of 1.5 to 2 million, they need to be looking at this. Now, I don't mean net income. I mean gross sales. So that's where it makes sense. And it could be an attorney. It could be a manufacturing company. It really doesn't matter. It can be a lot of different companies. And what happened is how this got started is people wanted to start doing pieces of their insurance. And so that's how the captive insurance industry got started. Most of your Fortune 500 companies do this. We're bringing it to the small to medium-sized business. So
same kind of thing then with the tax incentives. Most of the big companies already know about this stuff and take advantage, and captive insurance falls into that same bucket. So why don't you walk us through this rather complicated diagram?
Yeah. So here's what it is. You see, you have the owners, you have the business on the left. The owners, the same owners, start their own insurance company called a captive. The business is going to pay premiums to their own captive insurance company. They're going to keep those premiums, but they get a business insurance deduction on the business side. The money that goes over to the captive is tax-free because there's a special exemption that says you can deduct up to $2.3 million per year and not pay tax on it. If there's claims, the captive then pays the business for the claims through reinsurance. So you see, you're getting a business deduction because you're basically saving money for a rainy day, and you happen to get a tax advantage with it. Because if you have a business and you're a pass-through entity, your ordinary income rate, if you look down at the bottom, when your profits, when they come out to the owner, they may be 40%. Depending on what state you live in, they may be 50%. The money that you put in the captive, you can invest that money. It goes up in value. Now, you eventually do pay taxes on that, but it's at a lower rate. It's at capital gains rates, which are maybe 15, 20%. So there's this tax arbitrage, right? So I'm able to protect my business, which keeps making me money, right? Ensuring revenue streams, solidifying expenses. I get a deduction for the amount of money I put into the captive, and I don't have to pay tax on those premiums. So it's a great strategy that works for a lot of companies.
That's so the captive and the company are basically owned by the same owners.
Yeah.
That's a requirement.
That's right. They're owned by the same owners. And really, Tom, one of the big differences is how often has State Farm called you up and said, Tom, you paid us all this money. You never filed a claim. We just want to give you all your premiums back. Has that ever happened?
It never happens.
No, but that's exactly what happens with a captive. You keep all the premiums. You're not sending it off to State Farm, right? Now,
Right.
you're not self-insuring, okay? You're not dropping your traditional commercial insurance. It becomes more affordable. This is just extra insurance for unique things. So yeah.
Well, so let's talk about some of those unique things that it might be. So tell us some of the things and some of the additional benefits. It'll protect greater risk, but tell us about some of the things that you can protect and then some of the benefits here.
Sure, absolutely. Yeah. So, it protects your business from and decreases taxes and builds wealth, but you're going to increase cash flow. Who do you want to pay? Would you rather write a big check to the IRS, or would you rather have that money go over to your own captive where you can invest it. So it increases your cash flow. You have access to the reinsurance market. Pricing stability. You know, what's happened over the last couple of years is commercial insurance rates, for you business owners, you know what I'm talking about. They've increased, haven't they? Maybe 20, 30, sometimes 50% over the last year or two. Our clients stayed the same, or maybe even dropped a little. So you can mitigate the cost of your traditional commercial insurance with a captive and bring it down so you don't have to get those extra price increases. So all kind of different tax benefits. You're creating a whole new asset, right? I'm creating a whole new asset separate from my business. So whenever I sell off my business, guess what doesn't go with my business? My captive insurance company. And I may
you get all your premiums back.
You get all your premiums
just
back.
like State Farm.
Yeah, that's right. Exactly. So it's a great way to recover your premiums, build an asset. And again, if you don't use it, you don't lose it. Right? So that's a nice benefit of it. So how does it differ than traditional commercial insurance? That's kind of what I mean. You're getting your premiums back. You don't replace all your commercial insurance. This just integrates with it to work with it. But you're getting, coverage that's custom, that your traditional commercial insurance, they don't offer, right? An example is like, what about a key client? Some people may have only really 3 clients that bring in 80% of the revenue. And if they lost one of those clients, it would hurt them significantly financially. Well, your commercial insurance is not going to write that policy, but you can in your captive. So that if something happens and you're out $1 million, file a claim, pull from the reinsurance and get paid $1 million. So that's how it's different than your traditional commercial insurance, is that you're holding on to those premiums and you're getting custom policies that are not available commercially, or it's too expensive, right? So yeah, that's kind of how that works.
Well, so walk us through this. You show captive versus without a captive. So walk us through some of these benefits here.
Yeah, you see the pie, and you see your current commercial insurance. It's there and it's going to stay there, right? But the gaps, exclusions, limits, deductibles, all that, there's things that you're not getting coverage for. And that's what your captive can cover. Then you think, well, I don't want any more insurance. I don't want another expense. Look, you're going to take money out of your company, right? You might as well protect your cash cow, that business, and still get money out. You're just moving it over to your captive insurance company. Right now, you're kind of like self-insuring for all those things, hoping that nothing happens, right? You're not getting any tax deduction for that at all. You might as well get a tax deduction for holding that risk and leverage that money 10, 20 times for insurance policies to protect your business, right? So you have business protection, custom insurance, access to reinsurance, and you retain your premiums and you're financially ahead. So when you compare the two, I know it sounds weird. It's like, wait a minute, I thought we're starting a captive insurance company. How in the world am I financially ahead? We'll run the numbers and I'll show you, right? Because the government thinks they're partners with you in your business, don't they?
Yeah,
they think, hey,
they're the most equal partner in our business. Right?
So they may take 40%, right? So did they come to work 4 out of 10 days and work for you? I don't think so. Yeah, but you have to pay them as if they're a partner. If you have a captive, you can avoid some of that along the way. So what's covered by captive insurance? Business income interruption, commercial gaps, coronavirus, that hit a lot of people, didn't it?
You could insure against coronavirus here?
Absolutely. Absolutely. We had COVID-19. What about COVID-21? Hopefully that's not going to happen, right? But you can insure against crazy things like this happening in case that, in case that government shuts you down. So I mean, how many people have you heard about getting hacked and they can't, they're locked out of their business, and now they can't operate unless they pay $500,000. So where are you going to get the $500,000? And do you want it to pay in Bitcoin to some clown? No. If you have a captive insurance company, it's going to pay the claim, right? Deductible reimbursement. I'll tell you, we had a construction company that did this, and we were able to increase their deductibles. It drove down the commercial premiums. Now, Tom, this was a big construction company, all right? But their general liability, workers' comp, everything was $2.5 million per year.
Wow.
Imagine paying that insurance bill. They started a captive with us. We increased their deductible. It drove down their premiums by $1 million.
Wow. Wow. And you can use that $1 million to fund the captive, right?
Absolutely. Absolutely. So you still get that insurance deduction. It's just now you get to keep the $1 million versus having it go to State Farm or wherever and never seeing it again.
Wow.
So it's very important. What about regulation change? This happened year before last. A doctor had they were getting paid. They did long-term care in this nursing home, and they were getting paid 20 days a month. Well, then the insurance companies said, you know what? We're not going to pay you 20 days a month. We're only going to pay you 4 days a month. They call us up and they're like, I don't think we're going to be able to put anything to the captive this year because they changed our revenue is just got nailed. And we're like, file a claim. You have regulation change insurance. This is a regulation change. They collected, Tom, $1.5 million.
No kidding. Okay.
So they're still going today. Rental income replacement. You got any clients that have real estate? They're hurting right now, aren't they? If they're renting out office buildings or whatever, because people have bailed on their leases. If you had a captive, you could get paid what they would have paid you, even though they left. And you're pulling from rent. So that's kind of,
Now, this isn't just funded by your premiums. You're taking a portion of the premiums that you're paying and you're reinsuring, right? Against that. You're going out and getting enough.
You got it, Tom. All the policies are reinsured. And that's the key, right? Is that some of the money will come from my captive. Most of the money is going to come from the reinsurance.
Right.
So it's a huge deal. You end up financially ahead, even if you never file a claim. If you file a claim, you're way further ahead.
Oh, yeah. Well, so the question for you, because I know that you already talked about the transfer of the business and the captive stays with the original owners. Is this really just a wealth building tool?
It's not just a wealth building tool, but there's a component of it. If you start a new business, you're hoping it makes money. And that's what a captive is. You're starting a new business, an insurance company, and it is an incredible, it will probably be your most profitable business, right? Because the money you put into it is retained by you. It's held in there, and then you can invest that. A lot of you may use IRAs, 401ks, or SEPs. What's the problem with those? You can put a little amount of money in it, right?
Right.
Right. And so, but with a captive, you can put a whole lot more money in. You still get the same deduction, but you can put way more money into a captive that you can invest. And unlike a SEP, when you pull money out of a qualified plan, you pay ordinary income rates of maybe 40%. When you pull money out of the captive, you only pay capital gains. So it's a huge wealth building tool in that endeavor. And again, everything's reinsured. Something else to keep in mind is it's creditor proof. So something may happen to my business, right? But nobody can touch my captive. Nobody. Why? It's a state licensed insurance company formed right here in the USA. We only form ours in the US. And no one has standing. And because it's an insurance company, nobody can force the liquidation of it. That's the law, right? Wow. So whatever you put in there, no matter what happens with your other businesses, you get to keep what's in there.
Wow, that is incredible. Look, before we run out of time here, one of the things that I'd like for both Gerald and Ken to address here, what would you say to a business owner who already has a CPA and tells you, well, shouldn't my CPA be telling you about telling me about tax incentives and captive interest. So Gerald, we'll start with you. How would you react in that case?
Well, again, as you said, the scenario, it's tax year again. This new bill has passed the House and the Senate, but per usual, Main Street business owners are missing out on what it means to them. Now, the other side of the coin, just not to throw the CPA under the bus, CPAs are tasked with assimilating and applying these provisions to their client base, which is it's a daunting task. The majority of CPAs are conservative by nature, which means they have kind of a wait and see approach to this legislation. And that theory may sound good, but it's not a way to effectively manage a client base. So not a criticism of the CPA, but they simply should not be put in the position of immediately digesting every bill that passes and then tasked with applying it to each of their clients in their book. And for some incentives like cost segregation, the IRS doesn't even want them to do it. They want them to partner with someone like us that has engineers and tax attorneys, project managers, everyone needed to pursue these types of credit. It really is a partnership. So we do the work, but they still have to follow all the forms. We're not accountants and CPAs. Our firm is more engineers and project managers, things like that, capable of securing these programs. But again, the CPA has to sign off on them and file them in the end. So we're not a threat. We actually benefit.
So you're not cutting the CPA out at all. You're actually helping them find more money for the clients. What about you, Ken?
Yeah, I know the CPA world.
Because by the way, if you didn't notice, folks, behind his name there are three initials, CPA.
I am a CPA, and I've worked with people like your CPA. I've worked in a tax shop before where we did tax returns, personal, corporate returns, and I can tell you, by becoming a CPA and working in a tax shop, listen, they don't teach us these things. You would think that they would, but they do not. We have to do extra research in order to find out about these things. And some of these strategies require additional licenses. And a CPA, I can tell you, we got to get 40 hours of continuing ed every year. We don't want to have to get another 10 or 20 hours of continuing ed. So CPAs just don't research and they don't know about it. So
just like Gerald, though, you work directly with CPAs as well, and you're a resource for CPAs.
Yeah, we're not taking anything off of CPAs. We don't do that type of work. But yeah, we work with CPAs all the time that understand it and get it. And understand the value of it and how you're protecting your client, you're protecting their business. And Tom, most people think if my CPA could save me money, they would, but they don't know about these things, so they can't share with something with you that they don't know about. So,
right. And Tom, just keeping in line with beating a dead horse here, if a tax practice wanted to bring in-house all the things we do, they'd have to hire 15 plus vendors. That's way too much for the typical tax planner or even a regional planner to manage from a quality control standpoint or an oversight standpoint, right? And if you can't management, then they're not going to do it because the reputation of their clients is the only thing they have, and they are not going to put that in peril. So they just don't do it. We witness it day in and day out.
Yeah, and great CPAs have resources like you guys that help them with this kind of stuff because you just can't know it all. A 5,500 page bill, for crying out loud, on top of the normal tax stuff that comes out every year. I had a CPA one time that said he used to curl up on Sunday morning with a hot cup of coffee and all the tax changes. Good Lord. Yeah, it's a crazy thing. Well, great. Hey, before we take questions, and we're going to do those in a second, and I see we have lots of questions out there. For Ken, tell us how our listeners can get in touch with you.
Yeah, feel free to contact me at ken@captivenation.com. I believe Kim's going to share my contact information in the chat. Feel free to give me a call or email me. Our phone number is 866, 888-944-5588. And again, that will be in the chat feature as well. And so look, it never hurts to find out Does this work for a company? Question is, do they do 1.5 to 2 million in gross revenue, total sales, not net income? And do they have a business? Those are the two things. And then I'll get with you and do an estimate of, hey, what does it look like for them? What's the cost benefit look like? You know,
What do you charge to do that?
don't charge anything.
Oh.
We do a free analysis and assessment for any business to see if it'll help them out.
So, folks, we really touched on captive insurance. There's a lot more detail. If you missed it last year, Ken was on our podcast. You can find it on our YouTube channel or wherever you get podcasts. Just search the Maximize Business Value podcast episode with Ken Huffman, and you'll be able to find that. Gerald, same question to you. You know, how and why can a business owner get in touch with you to explore tax incentives?
Well, first thing is just decide, don't leave money on the table. Just don't. Once you decide that, they can visit our website, grab 15 minutes with me. They can shoot me an email. Our website is snapshotbusinessservices.com. That 15 minutes, again, can save you hundreds of thousands of dollars. But again, you don't have time, shoot me an email, Gerald@snapshotbusinessservices.com, and we can help you. We can use the tools that we have to help set you on the right path for that. Don't leave money on the table. Find the money.
And how much do you charge for that, to do that assessment again?
We don't charge for the assessment.
Yeah.
We're paid for execution of ideas. So I kind of think of it like Waze. You know, we all have Waze or Google Maps or something. The objective is we want to improve cash flow, and it's going to give you 3 different options. You know, you can choose whether you want toll or no toll, you know, whether you want to, suffer the traffic and ride through the neighborhoods, or do you want the quick route? With us, let us execute on your behalf, but it is your choice how you like to travel.
Awesome. And I know that there's a lot more information about tax incentives as well. And you can learn about those on our podcast and our blog post that comes out next Monday. Our podcast comes out. I did a podcast with Gerald earlier this week. So it is, as Kelsey said earlier, it is, Gerald's week here with Maximize Business Value and Mastery Partners. So, and by the way, for our members of our mastery class that started in January, you're going to get a second dose of these guys coming up in April, just so you know. So, of course, you can always reach out to me, and I will be happy to give you a warm introduction to my good friends, Gerald and Ken. But before we wrap up, Kim, questions?
Okay, sorry. If we have clients that currently have a CPA, what is the best way for you to work with, or in addition to a CPA?
I think we pretty much covered that when we were asking about CPAs. Okay. So is there anything else that you guys would add to that? Hearing nothing.
Okay. If I'm correct, micro captives are a transaction of interest and requires a tax filing each year. Ken, can you please address this?
Absolutely. Yeah. So there are 2 different types of notices. There's what's called a listed transaction and a transaction of interest. Currently, the captive is a transaction of interest. Some people abuse these things. Right? They set them up overseas. They don't know what they're doing, and they abuse them. We set up ours in the US. I'm a CPA. The last thing I'm going to do is risk anything to mess up my CPA license. This issue is currently before the Supreme Court. We expect a ruling within the next couple of months of getting this removed as a transaction of interest. There's no support for it to be on there as a transaction of interest. Other things that are on the transaction of interest is a trust. What's wrong with the trust? So there's things that appear on there that really shouldn't be on there. So we should see some kind of, it appears that they're going to remove it, but we'll just see.
Awesome. Anything else, Kim?
Yeah, Ken, if we only have one company, can you create your own captive, or do you have to go to a group captive?
No, you can create your own. If you just have one company, that's all you need. You can have your own captive, or a business owner may have 5 businesses and one captive could cover all 5 businesses. And so really it's, do they have the revenue to support it? Gross sales, is it 1.5 to 2 million? It's something to look at. Of all those businesses combined, is it 1.5 to 2 million? Let's at least take a look at it and run the numbers. So it doesn't matter if you're a manufacturer, any type of business, they all have risk.
Well, speaking of that 1.5 to 2 million, I see the last question here is, are there any other parameters or requirements that there would be for targeted businesses to be able to take advantage of this?
There is not. Those are the 2 main things. It doesn't matter what your commercial insurance is per se. We look at those policies to see where are the gaps, where are some things that they're missing out on that they're not currently insured on. But that's it. You just need to have a business, and and then we take it from there to see if it's a good fit or not. And if it is, great. If it's not, that's okay too. I'll tell you, this is not a good fit for you right now, and maybe later down the road it will be.
And the conversation doesn't cost you anything.
No.
So we covered lots and lots of information today. And so now what? I really want you to take 2 or 3 minutes to write down the top. If you didn't find one thing that you can do in your business today, you just weren't paying any attention. But write down the top 3 things that you're going to take action on right now. I always find that to be incredibly valuable. Anytime I go to a conference, anytime I do some online learning, I try to pick the one thing that's the most important. And so I want you to do that. And while you do that, I'm going to tell you a little bit more about Mastery Partners. We partner with small and mid-sized business owners to design and execute the ultimate exit strategy so that those business owners can transition their business on their terms and for maximum business value. We have a 4-step process that to get every business to the finish line. It all starts with step 1, the transition readiness assessment, where we examine the business end to end so you'll know what you're doing right, what you're doing wrong, and what needs to be tweaked. In this step, we'll also tell you exactly what your business is worth. Think of it as a snapshot of where your business is today. In step 2, we work with you to discover the ideal desired outcome for your business transition. And then, because we already know where you are from step 1, we build a bridge to get you where you want to be. We call this step the roadmap for value acceleration. And once we deliver that, you're free to go execute the plan on your own or engage with us to drive the process and get you to your goals. If you do it on your own, never fear, we're going to hold you accountable to getting the job done as well. And then finally, it's time for step 4. It's decision time. Are you ready to transition your business, or do you want to keep going because you're having so much fun and you're making so much more money and you found all these tax incentives and you got a captive insurance, you just don't want it to end? So that's our 4-step process. Look, there are thousands of firms out there that can help your business, and frankly, any number of them would be great for you or your business. But we hope you'll consider working with us, because here is what we are all about: ridiculous results, driving them, owning them, and achieving them. Educating and helping business owners. Frankly, that's what gets me out of bed in the morning. And creating massive value for business owners, just like I have in all of my business. I know what you're thinking. Where can I get me some of that? Well, first of all, you can join our weekly podcast. We host a weekly podcast series that comes out on Mondays. As I already said, Ken was a guest last year. Gerald is a guest coming up next week. Tune in to hear more Maximize Business Value Wisdom. We are everywhere that you can find a podcast. Just search Maximize Business Value, or do my favorite thing is I'm walking through any room with an Alexa. I'll walk through and say, "Hey, Alexa, play the Maximize Business Value podcast," and she'll start the current episode for you. I love that. And of course, we hold this monthly webinar series. Our next webinar will be the week before tax day. So you learned a lot of things about taxes today, a lot of things about reducing taxes. I hope you put them to use before we get together next time. And of course, go get a copy of my book, Maximize Business Value, on Amazon, or come visit me and I will be happy to hand you a book. And of course, we'd love to have you join us for our 12-month mastery class program. You can learn more about that exciting program on MBV Mastery Class, Maximize Business Value, mbvmasteryclass.com. In the class, participants work through our transition readiness assessment, step 1, and build a leadership toolbox and participate in a peer group community with other business owners. We teach business owners our success formula and the things you need to do to get to the next level. And we have great guests come on like Ken and Gerald, who will be with our mastery class next month. And although we've already started that first class, the spring semester is going to start soon. The MBV Mastery Class spring semester starts next month. So check it out right now at mbvmasteryclass.com. And of course, if you want to talk to me directly, you can go to masterypartners.com and click on the link to schedule a call with me. I thank you for your time, Gerald. Ken, thank you for being with us today and sharing your wisdom with us.
Absolutely.
Thanks for
Anytime.
having us. Appreciate it.
Enjoyed it. Thank you.
Thanks, folks. Have a great